Welcome back. We've had a slew of economic news over the past week or so. GDP, gross domestic product, rose at a rate of 2.6% in the third quarter. That's better than the estimate of 2.3%, mostly attributed to a narrowing trade deficit. So it certainly does not represent overall improvement or great improvement in the economy, but the trade deficit is a pretty big component in the measurement of GDP. The home price index rose at a rate of 13% year over year, down 15.6% month over month. The personal consumption expenditure, PCE, was released at a rate of 0.5%. That's in line with estimates and the prior report. Again, the PCE, personal consumption expenditure, is very similar to the CPI, consumer price index, but it allows for substitution in the market. So if consumers can't afford one product, they may purchase a different variation. But at any rate, that inflation remains in line with estimates. Durable goods were released lower than expected. Taking a look at the equity markets, top left-hand side, the yellow square over here, every dot represents one component of the S&P 500 with their individual RSI, relative strength index measurements registering here. Most of the stocks have an RSI between 45 to around 70. If you remember the last time we took a look at this, most of those dots were near the lower end of the range. So the past couple weeks, we've seen a pretty big move in equity markets to the upside, and this shows us that the relative strength index, which is a very reactive indicator, it has moved back to the upside. Now, on the top right-hand side, the histogram bar shows the count of the number of stocks with each respective RSI reading. So the greatest amount of stocks have an RSI reading around 60 to 70. So the market certainly has been strong, and this shows that to be the case. However, the bottom part of the screen, the green squares, represent the 52-week ranges, and the vast majority of the stocks in the S&P 500 are between the 5 to 40, 45 percentile of their 52-week ranges. So stocks are, over the long term, over the past year, they're still closer to the bottom than they are the top. Now, notice the difference between the RSI. Again, the RSI is much more of a reactive indicator, so it does show us that stocks have bounced, but that bounce has not crossed back above the middle part of their 52-week range. They're still down for the year, for the most part. And the bottom right-hand side shows us the count, and the vast majority of the stocks are between the 10, 20, and 30 percentile. So still, most of the stock market is near the lower end of their yearly ranges, despite last week's bounce to the upside. Bond yields have been increasing across the board. The 2-year bond at the highest rate of increase at 11 basis points to the upside, and notice that's much more than the 10-year bond yield. Interesting to see what's happened with bond yields. Top right-hand corner, the red line represents a total bond yields. That's if you were to add up all the yields from 30-year maturity, 20-year maturity, all the way down. The yields continue to rise. It looks like they have paused over the past couple of days, but they are continuing to rise. We do have a Federal Reserve meeting coming up very soon, and they are expected to increase interest rates. The blue line represents the S&P 500. So notice the inverse correlation. With the anticipation of higher interest rates, yields have gone up, and the anticipation of higher interest rates sent stocks down. Now we have a bounce back up on stocks, but the yields have not come down. That, in my mind, represents a little bit of a disconnect, meaning if stocks went down as yields went up, wouldn't yields go down as stocks go up? Well, this shows us a little bit of a divergence, and maybe that's a sign that something really needs to change, either that the stocks are going to go back to the downside, or maybe yields are going to start to soften. The bottom left-hand corner shows us the red line of the total bond yields, and the green line shows us the net spreads, the difference between the interest rates and the different maturities. So the difference between the 20 and 30-year maturity, or the 10 and 20, and that has declined to pretty significant lows, at least going back about 5 or 6 months. And that shows us that the bond market continues to contract, and that is not a healthy sign. Usually you want to see a greater range develop between the different maturities. but that certainly is not the case. So the bond market does not recognize whatever the stock market has recognized and the reason why it's going up. Taking a look at the black line, that's the S&P 500, going back to the upside. The green line represents the net spreads between the short-term bond maturities. So the 1 year to 2 year spread, the 2 year to the 5 year, etc. That goes up when stocks go down, and conversely, as stocks have gone up, those yields have gone down. However, notice very interestingly, the blue line represents the spreads between long-term bonds. The red line represents the spreads between the medium-term bonds. That has not changed. That has not gone to the upside. You would expect, over the past couple of months, we've seen the short-term bond yields go up. So, for example, the 1 year bond pays a 4.55% yield. The yield is so strong because traders have sold the 1 year bond and the 2 year bond and purchased the longer term maturities because traders are not confident about the near term future. Well, as they have done so, this green line has gone up. Now the green line has come down, but we would expect, okay, if they're starting to buy the short-term maturities, are they selling the long-term maturities? The point being is they're not. And we're not seeing a major turn in capital, a major movement of funds. The capital is adjusting in the bond market, but again, the bond market does not reflect what we see in the stock markets. Now, the stock market, of course, is also driven by quarterly earnings which are being released. So a couple good reports can send an entire index higher. So I don't know that the stock market moving higher is necessarily representative of the overall economy. The bond market is much more representative of economic growth or lack thereof. Left-hand chart shows us a relative strength of the different sectors represented in the S&P 500. The strongest sector is the oil service index. It's a Philly oil service index. Number 2 is an energy ETF. Number 3 is a Dow Jones Industrial Average. The weaker sectors include the volatility index. That's the VIX, the fear index, as well as NASDAQ computer index, technology sector. So the strongest sectors are energy, and the weakest sectors are, well, volatility's gone to the downside, deservedly so as stock markets go up, but also technology. So technology is not really participating, and that's not really necessarily a sign of a very broad-based economic recovery, so to speak. It's just the energy sector. On the right-hand side, we see the 52-week ranges. The energy sector is above the 90 percentile of its 52-week range. The 10-year bond treasury index also, and then the oil services index. Those are the three very strong sectors. Everything else is at or much below the 50% level. The weakest sectors, those sectors closest to the 52-week lows, NASDAQ computer sector, NASDAQ 100 technology sector, and gold sector as well. So we're not really seeing a reversal so far in any of those other sectors. Taking a look at the VIX, that's a volatility index. It's near the lower end of the Bollinger Band. The VIX goes down when stocks go up. The same holds true for the NASDAQ volatility index. So it's basically a risk-on approach. But again, the retreat from the current trend seems to be the strongest in stocks, moderate at best in other markets. Take a look at the US dollar. Now, the US dollar was the number one strongest currency we saw. It now has an RSI of 50, which has represented a really big decline from recent highs. Take a look to see what the US dollar has done. Over here, we have an RSI of 50. It was down near the 46 level. But we go back in time and we saw the US dollar had an RSI of 62. I think actually even a little bit higher than that at one point. So the US dollar has certainly retreated. During that time, what has been the strongest currency? The Thai baht. Number 2, Hong Kong dollar, Mexican peso, British pound. The weakest currencies, Turkish lira, Israeli shekel, South African rand, Swiss franc. So if you want to construct a currency pair, you want to see the rapid movement of funds, you take the strongest currency, match it up against the weakest, and we have something like the Turkish lira versus the Thai baht for example. That's one currency pair that has certainly a very, very strong trend. We want to take currencies from the top of the list and match them up with the bottom of the list to find those strongest trends. That's where the capital is moving into the Thai baht, into the Hong Kong dollar, and out of the Turkish lira and some of the other weaker ones as well. So that certainly is a very interesting phenomenon. I would expect that eventually this divergence that we're seeing will return back to what we would consider to be a more normal market condition, meaning that as stocks go down, that the bond yields will go up. And what we saw here is that as the yields continue to rise, or at least not retreat, stocks have gone up. This divergence is also very evident in the weak US dollar against the stock market as well. So something really has to give. And we certainly do have a lot of economic catalysts moving forward. We have the Federal Reserve meeting this week, as well as a number of other very big pieces of news in the very near future. So we're going to keep a close eye on this. We hope this has been helpful. We look forward to seeing you back soon.